Are you ready to take advantage of the 2023 economy? Yes. The current economic situation may seem challenging with high inflation, rising interest rates, and stock market corrections, but that doesn't mean it's time to throw in the towel. In fact, it's precisely during these tough times that the world's best investors are busy buying in. Take Warren Buffett, for example. Despite being heavily criticized for staying on the sidelines in recent years, he dumped a massive amount of money into the market in 2022. And he's not alone. Super investors have been buying in during economic downturns for years, from the 2008 financial crisis to the crash of 2020, and they've come out on top. So, what's their secret? Well, Manish Babri, a Warren Buffett disciple and friend of Charlie Munger, recently shared 3 investing rules to follow during tough economic times. And the first rule is especially important during periods of high inflation and economic weakness. Look for companies with a durable competitive advantage. Think about it. If you have a small city in England with no Thai restaurant, and someone decides to open one, they'll do well at first. But as more entrepreneurs see the opportunity and open more Thai restaurants, the economics of the industry in that small city will level out. This is the nature of capitalism. But, if a company has a durable competitive advantage, it can maintain its market share and pricing power, even during tough economic times. The second rule is to focus on companies with high returns on capital. This means the company is able to generate significant profits using relatively little capital. In other words, they're efficient with their resources. These companies are better equipped to weather economic downturns and come out stronger on the other side. And finally, the third rule is to find companies with excellent management teams. The right leadership can make all the difference in a company's ability to navigate through challenging times and emerge stronger. In the competitive world of business, having a unique edge is crucial to success. While being first in the market might be advantageous, it doesn't guarantee long-term success. The key to finding great companies that will thrive even in a tough economy is to identify those with a durable competitive advantage. As legendary investor Warren Buffett's protege Manish Babri suggests, companies with moats are the ones that will truly stand the test of time. Moats are intrinsic characteristics of a business that set it apart from its competitors and make it difficult to replicate. They give a company pricing power and protect it from losing market share to competitors. But not all moats are created equal. While some companies may be first movers in a market, this doesn't always translate into lasting success. As Babri points out, being first in a market may only work for a while until competitors enter the space and chip away at any advantages. One type of moat that is always difficult to replicate is brand power. Take Coca-Cola, for example. When the company was founded, no one could have imagined it would become the brand it is today. While there's nothing particularly magical about Coke, the company's brand power is undeniable. Pepsi may taste a little sweeter, but Coke's brand recognition is what gives it a lasting competitive edge. The key takeaway for investors is to look beyond the hype and find companies with sustainable competitive advantages that can weather economic storms. By identifying companies with strong moats, investors can invest with confidence and build wealth over the long term. Remember, the best time to buy great companies is often during a recession or market downturn, when they can be purchased at a discount. Take Warren Buffett, for example. In 2022, he invested heavily in the market, despite being criticized for staying on the sidelines in recent years. And he's not alone. Throughout history, the most successful investors have bought when others were selling, especially during economic downturns. This strategy has worked incredibly well, but to come out on top, you need to remember 3 fundamental rules. Manish Babri, a disciple of Warren Buffett, recently took the time to explain these rules. The first, which is particularly relevant during tough economic times, is to look for companies with a durable competitive advantage. It's not enough to be the first in the market. Being a first mover is nice, but it doesn't work forever. You need to look for intrinsic characteristics that permanently set a business apart from its competitors, something that another company can't replicate, no matter how hard they try. That's what we call a moat. The most powerful moats tend to be the brand moats. Despite being slightly counterintuitive, businesses with very desirable stickers have the strongest moats and are some of the best businesses to own as an investor during tough economic times. Essentially, having a moat means people will keep coming back to your product or service and won't switch to an alternative, even when they are tight on cash. But even with a strong moat, no business is invincible. Moats are likely to get filled in eventually. The key is to identify them and keep tabs on their strength through the years. As an investor, your job is to project what these businesses may look like 5, 10, or 20 years from now. Look at their long-term track record of revenue, earnings per share, free cash flow, and equity. Are they consistently growing at over 10% per year? Or are there signs of declining sales or negative media sentiment? Value investing is tough, especially in challenging economic times. However, according to Monash, patience is one of the most important tools in a value investor's toolkit. Value investors often lack an informational edge, and it's unlikely that they can uncover any new insights that the market has overlooked. So, what's the key to their success? Time. An investor's time horizon is the most significant advantage they have. By taking a long-term view, value investors can gain an edge over competitors who are too focused on the next quarter's earnings report. As Jeff Bezos once said, "You have to look out longer, further into the future, to see what your investments might be worth in the long run." This approach applies to both companies and investors. For individual investors who manage their own money, having a long-term outlook is essential. Unlike active funds on Wall Street, there's no pressure to make quick profits. The game is played over the long run, and the goal is to find great companies at attractive prices and wait for their value to be realized. Yes, it's boring, but that's the point. Value investing is a game of patience, and the rewards can be significant for those who can wait it out. Investing is a game of patience and requires a long-term outlook. Our biggest advantage as value investors is having the ability to think beyond the current crisis and wait for the recovery to kick in. This requires relative inaction, waiting for great opportunities, and then focusing on holding these businesses for the long term. The index is a great example of this, as it holds on to great businesses for decades, allowing them to compound and generate high returns. In contrast, active fund managers often fall into the trap of short-term thinking, which impairs their ability to generate long-term gains. By staying invested in businesses with proven moats and holding them for a long period of time, we can reduce the risk of loss even if we make a mistake with our valuation. Another approach is to identify a great compounder and pay a reasonable or even an expensive-looking price for it. By looking around the corner and having a crystal ball that can tell us what a company might look like 50 or 30 years from now, we can make great investments that can generate massive returns. For example, if we had bought Microsoft or Walmart when they went public, we would have done extremely well, even if we had paid any multiple for their valuation. Long-term focused investors can accidentally buy high-quality businesses at expensive prices and still do well. It's important to hold on to these great businesses for a long period of time, unless something fundamental changes. Only a small percentage of listed companies qualify as great businesses, so once you find one, hold on to it tightly and resist the temptation to sell unless it's egregiously overpriced. Water the flowers, great businesses, and cut the weeds. So there you have it, the not-so-secret formula that value investors use to profit during tough economic times. First, find companies with intrinsic characteristics that set them apart from their competitors. Second, hold on to these companies for the long term. And third, don't panic and sell before they have a chance to compound for you. Remember to always stay rational. If you enjoyed this video, please leave a like and subscribe to the channel for more. Thanks for watching, and we'll see you in the next video.